The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. The world is on the cusp of a new era. The U.S. economy is in healthy position, supported by cyclical and structural tailwinds and a Federal Reserve in easing mode. But with uncertainties remaining, how can investors better position their portfolios? How can they seize on the opportunities to generate additional value based on strong convictions around specific markets and segments? And what kind of flexibility should investors maintain to help react to unexpected surprises, be they positive or negative? Well, to find out more, joining me now is Dong Chen, who is the Chief Asia Strategist and Head of Asia Research at Pictet Wealth Management. Dong Chen, welcome to the show.
Good afternoon.
Good afternoon to you as well. Dong, how would you describe the financial landscape as we begin 2025? What are some key themes that will impact financial markets this year?
Well, I think heading into 2025, we're looking at a global economy that seems to be in okay conditions, especially U.S. looks to be kind of resilient, healthy, but more headwinds for the rest of the world. But I think the level of uncertainties are pretty high, especially, given the potential new policy actions from the U.S. government under Donald Trump.
I see. Well, let's take a look at some of the impact these themes may have on asset classes. With U.S. Fed likely to continue to ease interest rates, how might this impact the value of cash? Is cash no longer king?
Well, cash was a very highly considered asset class during the past about 2 years since the Fed started hiking rate quite aggressively. But I think going forward, the return that people can expect from cash probably will be dropping fairly quickly, at least compared to the kind of return investor can generate through other instruments such as corporate bonds and so on. So at this point, we are advising our clients to move their cash position gradually into some fixing products such as corporate credit.
I see. Well, with rate cuts leading to the yield on cash to tumble and even turning negative after inflation, should investors then steer away from U.S. investment grade bonds?
Well, we still see value in U.S. investment grade bonds, but in relative terms, actually, we prefer euro-denominated bonds even more. That's because we're seeing some potential divergence in monetary policies between U.S. and the rest of the world, particularly Europe. For example, given the higher inflation in U.S., we think the Fed probably will cut much less than what the ECB is going to do. So in this context, so the interest rate in Europe probably has more room to drop, which will benefit euro-denominated bonds much more than U.S. dollar-denominated bonds.
I see. Well, what about in terms of equities? How are equities set to fare in 2025? Are there, certain markets that will strive above others?
Based on, what we see, the potential divergence in economic performance where U.S. economy likely to outperform. So we think possibly U.S. equities likely will do better than those in the rest of the world. At this point, we favor U.S. equities as well as Japanese equities, and we're cautious, European equities and emerging markets as well.
I see. Well, given looming uncertainties in today's financial landscape, how should investors then navigate risks? Are there any investment strategies that they can consider?
Generally speaking, of course, diversification is always the number one rule, to build a portfolio. And on top of that, we think that there are certain kind of asset class investors can consider in case some terrorists arise. For example, we continue to favor gold. Right? Gold had fantastic performance last year. Despite the fact that it has already reached elevated levels, we continue to favor gold as one of the few asset classes that investors can really rely on when things turn bad.
Right. Well, on the note of investment strategies, I just want to ask you, Dong Chen, what is core positioning and how can investors take advantage of it to ensure portfolio resilience over the medium to long term? Why might core positioning help in 2025?
So I think in such an environment of higher uncertainty, portfolio construction is really important. So we are advising our clients to take the approach of having some core positioning supplemented by some satellite strategies. So for this year, for example, the core strategy, as we just mentioned, one of them is we favor U.S. equities over the rest of the world. And the second one I already mentioned as well is that, euro-denominated bonds or, Swiss franc-denominated corporate bonds actually could perform better than others. And lastly, we favor U.S. dollar in terms of currencies. And based on this set of core positioning, we can have a few other, strategies to supplement it to help our investors to generate better returns.
What are those strategies then that could supplement that strategy?
I'll give you just a few examples. For example, we like cash-rich companies in the current environment. Think about U.S. Potential new policies of additional tax cuts on corporate income tax, right? But to think about it, only those companies actually can generate profits. Mm-hmm. They can benefit from these additional tax cuts. And also in an environment where interest rate likely to stay higher for longer, especially in the U.S., you want to own those companies that can generate a lot of cash instead of having a lot of debt on their balance sheet. So cash-rich company is one of the strategies we have. Mm. Another is, looking at financial sector in the U.S., which could benefit a lot from the potential deregulation policies. So those are just two examples of those kind of strategies.
I see. Then what are some of the core convictions of 2025 that investors should take note of?
We just already mentioned some of them. On top of this, actually, we're also looking at some convictions. For example, where we basically observed that merger and acquisition activity picked up recently. And we think this trend probably will continue going forward. Two things. One is we're seeing, economy in the U.S. continue to do well and with improved confidence by CEOs, and that could lead to more M&A activities. And deregulation will help as well. A removal, a lot of those kind of financial regulations actually could make exits a lot easier. All this could help the M&A activity. So we actually introduced some strategies specifically to take advantage of this trend.
Right. Then how can investors also prepare for any, negative surprises? Are there any asset classes investors can consider?
Earlier, we mentioned gold as one potential hedge against some of the negative shocks. On the currency front, actually, we're also looking at some current very resilient currencies like Swiss franc. Swiss franc actually has been a safe haven for many years and has had this long-term appreciation trend. It performed particularly well in periods of time when things got very volatile, right? Mm-hmm. So traditionally, Japanese yen used to play this role, but in the past few years, I think increasingly, Japanese yen has been very, very volatile. And I think the safe haven nature of yen has decreased. So in this environment, we really like Swiss franc as a potential hedge.
I see. What about in terms of positive surprises, such as, let's say, if Europe's prospects improve or should fiscal prudence prevail in the U.S., what asset classes can investors consider to optimize on their returns?
Well, earlier I didn't talk too much about European assets, European equities. At this point, actually, we maintain a underweight position over European equities because, as we said, the macro outlook is not that great, and you have some political instability there as well. So this is almost a consensus kind of bearish view on Europe at this point. But imagine when the market is so similar in terms of thinking, so there could be a big kind of positive surprise if things turn out better. For example, one of the reasons people, are bearish about Europe is, on the political front, imagine if Russia-Ukraine war can end earlier than people expected, or the politicians in Europe actually put their act together and lead to a better kind of outcome in terms of the government, in terms of fiscal situation. I think those could be positive outcomes. So that's why we would like to use some derivative kind of instrument to try to take advantage of this kind of potential upside surprise through optionality.
I see. Well, thank you so much, Dong, for your time and your insights today.
Thank you. My pleasure.
Thank you. That was Dong Chen, who is a Chief Asia Strategist and Head of Asia Research at Pictet Wealth Management. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.